It has come that time for our Trader Talk segment, and today we're going to talk to Brett Manning, aka Chart Trader. And Brett, I'm going to welcome you in with a quick question here.
Sure.
I've noticed that some of your activity has been limited to some extent, I would say. You had a few here and there, picking your spots, and I assume that has a lot to do with this headline landmines that I like to call it, really trying to assess what is going on before you make a trade. Is that a fair assessment of your current trading situation?
Yeah, sure. I mean, not all volatility is created the same. When it is constantly driven by headlines that are breaking every few minutes, it's not really the same dynamic. The dynamic that really works well for trading aggressively during a high volatility environment is where you know you're going to have extreme conviction in the evolution of patterns. When you have a higher volume environment or higher volatility environment, people take cues off of herd behavior when it's not driven by moment-to-moment headlines. So you end up really being able to have a tremendous amount of faith in pattern setups following through, you know, when you break a level or when you pull back from one, that there's going to be a great deal of force to the causality of the pattern in and of itself. And instead, when volatility is driven by constant new breaking headlines, that the exact opposite is true. You never can have faith in how patterns are going to work themselves out because it's always reacting to something external, something exogenous from the market. So you need to be careful. But there are still dynamics that can play out with relative certainty. Yesterday, right into the close, for instance, the short that we took in the NASDAQ, we saw a big squeeze going because people had piled in short given the headline flow. We started to see some headlines that put that into question, but we had some more breaking news that was set to come after the bell. So, you know, when you see the sort of fever pitch of that squeeze start to abate, you know you're going to get some hedges put back on right in front of the close. So that was a dynamic we could have some conviction in. But you know, it's going to be about picking your spots and at least getting past the initial. I mean, it's not going to be like this for 3 months. You know, we're going to start to get a narrative here, and the market's going to start to move according to that narrative. There will still be breaking news that comes along and shifts that narrative. You're still going to have to watch out. But right now, we are just acclimating over the last 48 hours, really. We're just acclimating to the fact that this isn't a subordinated news story. It's not some part of a fake news whatever. There's something very real that's happening, and we don't know what shape it's going to take yet, but it's going to be really, really important, and it's going to be front and center, and you know, there's going to be a process that plays out at this point without any doubt that's going to have a lot of different dynamic possibilities to it. So we're just adjusting to the fact that this is going to become the dominant story probably for a while, and I think the market is really coming to terms with that, and that's going to be a process. And as we start to get some patterns in play over the next couple of days that lead to something on the 60-minute chart you can start to take a look at, then we'll be able to see how big money is starting to position around it, and then we'll be able to respond to that.
I'm glad you articulated that earlier about not all volatility is created the same. And I've always tried to preach that there's good volatility and bad volatility. And when I stress what is quote-unquote good volatility, it's what I like to refer to as more predictable volatility. You know something is going to happen, and you can kind of structure your trading around that type of dynamic. And where I kind of developed it from was I like to see markets have a big move, whether it's in an equity market or any commodity driven market. You'll have a big move. And I don't like that big move because it's somewhat unpredictable. The good volatility comes afterwards, where you actually have some semblance of price discovery, and then you can now somewhat quantify where your ins and outs should be and base your risk around it. So the only problem with that now is I heard something today that I didn't really like, and that was when there was a headline that Nancy Pelosi said that there's no rush to judgment on this and they're going to take their time. What that means to me is we have more environment of an extended bad volatility with speculation headlines coming out all over the place, so it really makes that really difficult to assess, in my opinion. I don't know what your take is on that.
Yeah, so two things. First of all, I couldn't agree with you more about the same thing that you just described as far as reactive context to volatility. I call it range expansion. First day of range expansion is tough to trade because you're going to be constantly put in a position of, seeing that one big move as it's developing partway through in the context of the prior smaller range. And so it forces you into a position where you need to identify that dynamic really quickly, or you'll end up losing a lot playing reversion to the mean because it's expanded beyond where the volatility has been set at. So we get the range expansion bar, it creates a new context, and then we get price discovery inside of that widened range price context where you're going to see the algorithms have backed off a little bit in terms of clogging up the inside market. You get more follow-through in patterns. That reaction and reaction to the reaction and reaction to the reaction of the reaction that forms the pattern in response, that's right. That's much more productive trading than the first sudden whoa move, when the market just starts to make a big move. As far as the context and how it's defining itself, you've got to remember that Pelosi's going to say a lot of stuff right now that preserves the credibility of this process. So she can't look like she's jumped to a conclusion irrationally. So she's going to constantly kind of make it seem as though there's an evaluative process that's going on where nobody has pre-concluded or prejudged anything. And that means when they do get to when they're concluding and judging things, that she's preserved the credibility of those conclusions and judgments. So you're going to see that positioning by her. But I think there's no question this is going the full place that it's going at this point. I don't think there's any way that this is not going to be on the Senate floor at some point, and we're fully in an impeachment hearing. So obviously the game theory around that is Republicans control the Senate, and that gives them a tremendous amount of control. It's like they own the home field advantage. They're going to be able to set a lot of the rules. They're going to be able to decide whether certain witnesses should be allowed, what evidence should be brought up. They're going to have a lot of control. The White House's legal team is going to get discovery. They're going to be able to call any witness they want. So there's a lot of dynamics that could turn into more about Joe Biden than anything else. I mean, there's all sorts of directions this could go. As far as whether or not there's any chance that there will be anything other than a political decision that's prejudged as far as the Senate being Republican-controlled and having a Republican president up, most betting odds at this point are that there's no chance that no matter what process takes place, there's no chance that the Senate will convict Trump and throw him out of office, and just that's a political decision. I think that's the standard assumption right now, probably by the market, probably by most people, that it would have to be really extraordinary and incontrovertible for them to take that step. I think that it's interesting to try to explore that idea. I think that people make that assumption until it's not impossible that we get to a tipping point where it becomes more politically scary to defend Trump than it is to support him. These people are, at the end of the day, thinking about their own careers probably just as much as anything, and by not flipping, if the evidence gets that severe, could be something where they become one of the few people still supporting somebody who ends up ultimately losing. Which would be devastating to a career. So I think there's a lot of game theoretic ideas here. The other thing is that this is clearly going to hurt both Trump and Biden at the same time, which means it elevates Elizabeth Warren. So you may see some Republican senators who are put in a position of thinking, in some ways what they're doing is deciding whether they want Elizabeth Warren to be president. That comes into the conversation as well. So I think there's a lot of game theoretic dynamics that supersede the flow of evidence coming out and the performance and the stage play that we're set for. But I think there's no question, regardless of how Pelosi couches it, I think there's no question now, given what we've seen, that this whistleblower report seems to be extremely credible. And that was an important piece of information. It doesn't look like a haphazard document by somebody who was irresponsibly judging things. It looks like it was a decision that was taken very seriously. And, one of Trump's own appointees is the one that finally brought it out into the light. So, that suggests right there that it's got an inherent seriousness to the situation. And now, the way that this is being handled so far this morning in the hearing, I think it further suggests that there's going to be no way to stop this from heading to whatever final destination it's going to be heading to. So this is going to be with us, and I would suggest it's going to be with us for months. And there's going to constantly be breaking headlines, breaking news, breaking ideas, shifting perceptions around it. But I think this is going to be volatility that's going to become good. It's tough now. We are becoming very reactive right now as we start to form the initial way that this is going to interpolate itself into price movement. And then we're going to start to get patterns. I mean, it takes a while to move around huge portfolios. And when somebody makes a decision, let's say to de-risk, or that this is actually, there's the possibility that even with this becoming a very serious issue, even with it possibly meaning, maybe the Senate GOP will flip on Trump. That doesn't necessarily have to be market negative. So there's also the process of the market figuring out whether the outcome of this has tremendous consequences or not for asset pricing. So there's how's this going to go? How serious is this going to be? How much is this going to further divide our government to remove our ability to do things like fiscal stimulus? There's also cyclical issues that come into play. You need to get people aligned to be able to do new forms of stimulus. Gavin and I talked the other day about the running narrative here is that there's a kind of gradual loss of faith in a traditional monetary toolkit and the need to come up with new fiscal measures. New fiscal measures will largely need Congress to work together. So if this is divisive right as the cycle is turning, that's a particularly bearish way for the market to start to look at this situation that has nothing to do with whether Trump is guilty. Like, the narrative here doesn't have to be about how this works for Donald Trump to be about how this works for the stock market, for instance, or for crude oil, or for the dollar, or for bonds. So there's a lot of different ideas, and I think it's important you get a sense of how those questions lay out. Maybe write an outline out on your whiteboard at home. Everybody just kind of say, here's the questions that are important for asset pricing, not just for, this interesting drama that we're watching and the fate of people. But, what questions are really going to go into the mind of large asset managers and whether there's more risk in reducing exposure to risk assets than there is in increasing exposure to risk assets. So there's a lot of difficult tipping point questions, but ultimately we'll start to see the ultimate manifestation of those questions is the type of pattern structure that develops over the next, say, 3 to 5 days on a 60-minute chart of the S&P. It's going to be the most important piece of information here. And, just keep an open mind and don't, prejudge that. This morning I put up a chart that suggested that the tail that we formed yesterday and the bottom that we came off of is a particularly vulnerable point right now because you've got a kind of bull flag situation in an upward trend with the 50-day average right underneath it. There could be a whole lot of speculative risk bets that are ultimately weak hands that are sitting there with stops just under there. If we form a sideways range over the next 2 days and then dip below it, you could see some acceleration to the downside and ultimately a move back below those range highs that we'd have formed all through August, basically, which are just underneath that as well. So you've got stops from the breakout plays, you've got stops from the moving average, you've got stops from the tail yesterday. That's a big pocket of stops, and I think if we form like a descending triangle over the next 2 or 3 days and we get a sense that we've started to get the outlines of how this process is going to go and it's going to take a while, and we start to see that offer forming the descending triangle top, the sloped line along that with all those stops underneath it, I think that there's possibly a pretty ripe swing short in the market that sets up along those lines. But if that type of pattern fails, it shows you've got a big bidder sitting under there rather than stops. That's important information too. So, I'm in a bit of a wait-and-see process. Yeah, I like your characterization of volatility increases, and I think that the questions here aren't necessarily all about how this is going to go for Donald Trump.
All right. Now, the only other thing I want to talk when in terms of volatility is we'll see it. I'm going to take a peek at the VIX real quick here, and we're trading at 16. And we haven't seen anything sustainable over 20 for a long time. We'll have little pockets where it might, but it comes back in so quickly. And, let's talk about markets back in the early 2000s, and then when we saw the disruption back in 2007, 2008, 2009, we had sustainable VIX levels above 20, where it really presented really good trading environments for a long time. But every time we get it, they smack it right back down. I'm talking about the VIX. So,
VIX.
Yeah. And here we are now back at 16. And to me, 16 is somewhat no man's land. I mean, it's at the lower end. I guess you could call it the midpoint, but really it's the lower end of where I'd want to see good trading environment be. So that that there's our other problem, I think.
Good trading being above 16.
Good trading being in that 20 that
Oh yeah.
range of 18 and better, 18 being kind of the lower end of good trading. 16 is like nothing to me. It's just kind of no man's land.
Yeah, I agree. I like the, I tend to have a system. I used to try to quantify it where I would say anytime we get the VIX to close above 2250, then I increase, my size, my frequency, etc. And as soon as we get a close back below 1750, I then shift back down. But I found it's better to just, the VIX is part of it. My sense of the patterns is part of it, and I'm a little bit more subjective with that. But I get what you're saying. 16 is kind of in no man's land here. I think part of this whole situation is we had some cyclical risk, but we shifted to an easing context, and so that's going to suppress volatility. Everybody else around the world was already easing, and now the U.S. is easing too with 2 rate cuts. And we're talking about fiscal stimulus. So the central banks are stepping in ahead of when you would normally expect them to, and that's probably part of why it's been so tough to hold volatility above 20. But, if we get cyclical risk now, we get this loss of faith in monetary policy, and we get the sense that this process that we're watching right now around the whistleblower report and impeachment, divides Congress further so that they're really incapable of managing to get the House and the Senate on the same page for fiscal stimulus if it's needed, if we start to see a serious deterioration. Then you're going to see a whole lot of trading with the VIX above 20, and I guess it's just it's a case of that tipping point relationship between what policy tools we have and the seriousness of our need for them.
The other aspect that I think we need to take into account is how this relates to the trade dispute with China, because this gives everybody even less incentive to do anything.
Yeah, right. Sure. Oh wow. Think of your China. Yeah. I mean, you're more confident probably now on some level that Trump's got enough problems that he might be easier to deal with, or that you can just wait out the process. Now Elizabeth Warren's been pretty, she's a populist too, so Trump and Warren are kind of similar in terms of how they would suggest that they would handle the China situation. So I don't know if this is something that's injurious ultimately, and I would expect this becomes ultimately injurious to Biden when it gets to the Senate and the Republicans are control of the game, the playing field. They'll probably take advantage of that situation to make sure that this story is not just about whether Trump had a coercive process in his dealings with the Ukraine, but why, and that the whole saga with Biden gets dragged out and probably focused on a lot as essentially a national spotlight free negative campaign ad that takes Biden out of the race, because I think that the zeitgeist on the moderate right and center, and anybody who is sort of moderate right, who is ultimately still in Trump's camp, would probably believe that Warren will be easier to beat in the general election than Biden. I think that's the zeitgeist there. That suggests then that they can actually use this situation to make a Trump re-election more likely, but there's obviously a tremendous amount of complexity in trying to game that out. But yeah, I would say at this point, here, hold on one second. Can you talk for a second? Jim?
Yep, I'm here.
Go. Can you talk for a second? I got to check something.
Yeah, so let's take a peek.
I could jump in and Jim give you a hand here.
Sure,
Market's bouncing a little bit off these lows. Just watch that 2966 level in the S&P. Haven't really seen any headlines that I would necessarily attribute to this move or this bounce. Obviously, there's a lot crossing the wires here.
You don't see anything?
No, I'm not seeing anything at the moment. The only thing that's come across really as of late was the U.S. saying that Syria used chlorine in some attacks on its citizens. I don't think that's really impacted anything. There is a Fox Business breaking report about an update on China trade and Huawei. So I don't know, maybe the president's looking to divert some of the attention away from things and striking that deal that, perhaps that's leading to it. I hope it is, because I know I'm leaning up myself, Brett, for a little bit of a short here. But
well, here, let me tell you why I paused, because, so I see that there feels, the way the orders are coming through right now, and the way that they did since about 19 minutes ago, and we got a little bit of a kick of an uptick, and then a couple of stops got popped out, is one of the things that I'm attempting to do right now in my waiting before trading more aggressively is really about trying to understand what directional relationships are attributed to which headlines. So we get a sense that's been, in my experience, the best way to get a sense of how to kind of map out in a headline minefield that does present volatility, how to be able to trade it more aggressively as you get a little bit more of a feel of things when you know which sorts of stories are likely to be the focus and whether they end up being bear items or bull items if you've got things stacked up. I imagine we have plenty of short interest trying to lean on levels right now. So when I see suddenly you get a little bit of pop, it's not very much, but when I see people who were maybe over leveraged pressing on 2965 area, when I see them give up a bit and you get a little bit of a pop, it's imperative for me to understand if there was a headline and what it was, but you're saying you don't see anything that looks like it was maybe out, 1 or 2 minutes, right at noon, basically.
Yeah, and like I said, Brett, just keeping an eye out. I see Mike Pompeo is making some comments that the U.S. will not let Assad attack go unchallenged. So perhaps they'll be launching some missiles over into Syria here. We have to kind of continue to watch this, but I haven't seen any smoking gun headline that would have suggested a pop off this 2966
It's not a big move, and it may just have been a technical kind of shakeout. I mean, you have probably a lot of people crowding into some aggressive short positions right now, just given the headline narrative and the way that it's evolving. I can imagine that that's the case. And when that's the case, it may not be a headline. It may just simply be that a shakeout is triggered because you've got too many weak-handed people in short, over-levered, tight stops get tighter as they kind of press more for the breakout, increase their size, tighten their risk parameters, and then you get a little bit of a kind of domino effect. So it's possible that has nothing to do with headlines. If you see something, though, kind of chime in.
Yeah, I'm obviously watching, and we'll keep an eye out for anything.
Thank you.
All right, Brett, I think we covered the equity markets pretty well, unless you have something more to add to it.
No, I guess we have, and it's going to be interesting, and I'll just kind of keep on posting my thoughts as I get a sense of what I want to do with the situation. I think there's going to be a lot of interesting trades. It's just we want to get past where we've started to establish some confines to the narrative.
All right, so I haven't talked to you about crude oil in a little while, and we had that big push up, I guess it was 2 weeks ago, and we've now pulled back to where we've closed that gap. We had that gap closed yesterday. If we didn't close it yesterday, we officially closed that gap today. Now, does that suggest anything to you that we could be on the cusp of another rebound to the upside?
So no. So I think you'll overshoot. My bias would be overshooting. We got to the moving averages now. I would point to the fact that the week before the attack in Saudi Arabia, we had the largest, I think, God, I don't want to get this wrong. I think it was the largest ever 1 week inflow of speculative long positions in oil. So, and it really makes you think it was the week before, and I would just suggest that crude oil is, of all global markets, is maybe the toughest to regulate in terms of that kind of dynamic. So it may be, that this was somebody knew something and this is how they financed it. I don't know. But that is also the point that you have before this attack. You get up there, you're going to have a big, heavy offer because you got to monetize that kind of process. So that's been weighing on the market. There would have needed to be a situation where Saudi Arabia had a tougher time getting supply back online, not a much easier time than was expected. And of course they had a huge incentive to do that. Some people initially were thinking this helps them because it raises the price of oil. They like the price of oil being up, but that's not the case because they don't have a sustainable relationship with the West if they look like an unpredictable or unreliable supplier. So much more important than where the price is, they need to look like they're not vulnerable to constant supply disruptions. So I think getting, the everything flowing again was absolutely job number one. So when you come into that gap up on this with already a ton of new long positions and possibly long positions that were predicated on that move, and therefore they would have been, working on the offer pretty quick there, I think you have the vulnerability for it overshooting back the other direction because nothing has really changed fundamentally about the situation. The one way in which we would see support is if we started to get any kind of signal that this is not a one-off event and that now we have a premium that has to be built into the market because we're going to constantly see things like this. So, it's just another couple weeks before there's another drone attack or whatever on some other major point of supply. That's not impossible, and maybe the market's going to have a process of kind of thinking about that. To the extent that doesn't look true, I think we overshoot and we cut under the lows that preceded this initial gap, which would put us somewhere around 53.50-ish. So if I was short this market, I would be targeting that. So not just a move back to the continuous contract 50-day, which is about where we are now, but I think you want to overshoot the pivot that preceded this, just based on dynamics involved in exposure.
I was looking out at some of the contract months, like say April, June of 2020, and it's pretty. There's a pretty big spread. That's backwardization, right? Where you've got, like say, I'm looking at the June contract right now, and it's trading like 53, so $2 below. Or is that contango or backwardization?
Hold on one second.
Yeah, sure.
Sorry.
Almost $3, really.
Okay, so right now we've got serious backwardization.
Right.
Yeah, big time. So, and that's because this is not, again, it's just as we were saying, that this is the suggestion that the supply disruption is the reason for the higher price. It's above the price that the market thinks is probably more reasonable for oil given a lack of supply disruptions. So it really just applies to, close-up contracts. But it's not like every contract is way under. So we have a generalized backwardation as well. So, I'm not really exactly sure what to make of that in this context, and I'd have to think about it more. And so I don't want to pin myself to an answer there, but I will think about it because it is important if we've just shifted to strong backwardation.
Yeah, and that's one of the reasons why I wanted to highlight it. It was something that I noticed. I know you can put it into context better than I can. And the funny thing is that the November, December, and January contracts are pretty close together. And then you got a pretty big drop off in March, April, June, and that's where you see the big drop off. Some $3 for the June 2020.
Hey guys.
Yep.
Sorry, just to interrupt, but bro, just keeping you abreast on the situation here. Seeing the headlines that there's been no decisions made on Huawei. It's coming from Fox News. So obviously disputing some of the earlier headlines we were seeing. So if this is the case, then that would suggest to me that trade's still the dominant market mover in terms of headlines right here.
Okay, thanks.
And just to be fair, I believe that that headline that we saw a couple hours ago about Huawei, it said it was likely that there would not be an extension. So therefore, I guess they're just following up saying there hasn't been one yet. Time will tell, I suppose. But just wanted to make sure that there wasn't any decision prior to this, and so just making sure we got all our headlines straight and whatnot. So we do have the S&P now trading back around that daily pivot, and which means it's also bumping up against the bottom of the opening range. So we're at key inflection point here. All right, then I'll tell you what, Brett. Why don't we table our crude oil chat for maybe next week, and that'll give you some time to see what to make of that backwardization in the back month of the crude futures. We got to talk about how much money you're making. Well, the good position you're making or you've made in the euro. That one continues to drift lower. It's a slow drip, but it's steady.
It's steady.
And you have no inclination of taking this off anytime.
No way.
Anytime you're shooting for parity. And
yeah, pretty much.
And
what crisis, quite frankly.
Well,
I mean, the choice point. I'm shooting for the choice point. Is should we continue with the euro?
And so break down what has to happen. What
Well,
are
I
the
mean,
type of headlines that we're going to have to see from either the EU or ECB or whoever it is that is going to give this that catalyst to just push it lower? And what type of time horizon are you looking at?
that's an interesting question. I don't know. I mean, it's trending, it's working, and it's working in a kind of grindy fashion without a lot of emotional extension, which is fine. And I feel like there's enough people on the other side of it that if we tip over into a more dramatic version of things, that there will be some emotional extension as people give up on the other side of that. So I think that that's set up. I don't know what's going to happen. My general thought is that we are getting to the point where the drumbeat of fiscal stimulus is starting everywhere. And my theory is that there are reasons that aren't necessarily always in the headlines for why that's not going to be an easy thing to achieve. In the EU, they've got fundamental rules involved, and they've got poor balance sheets. And the idea that there's going to be an easy time to get the Germans to do fiscal stimulus for the benefit of the Italians, given the context that we have right now, strikes me as lunacy. And if we're in a situation where that's what's going to be necessary, then I think that, I don't see how we don't start to get a series of threats for new exits. And it's going to come to a crisis point, and the resolution of the crisis point is either going to be the breakup of the euro, or it is going to be the establishment of a fiscal union in Europe. And, the establishment of a fiscal union, I think, would be hugely euro positive. It just seems like it's a difficult political environment for that to happen, particularly when there's such a disparity between standards of living in different areas in Europe. So that's the basic idea. It's driven by the political environment and by the rules that are already integrated into the European Monetary Union, and about the difficult time that the European Parliament has in moving with anything dramatic. We're seeing so much evolution of the thought process with the ECB, and Gavin let me know yesterday that he'd even seen something from Draghi talking about the need for modern monetary policy or modern monetary theory in the EU, and to really look into it. And we're seeing defection from the ECB from the Germans, and a lack of policy support from anything that looks fiscal, and the whole thing just continues to set up that there's a need in place, and that the structure of the situation doesn't work to fulfill that need there, and it does in other places for the most part. So it's a dramatic failure of the current construction of the European Monetary Union, that there's not a fiscal union. I've been a believer in that for a while, and this point in this cycle, as we start to see markets discount the likelihood of a downside of the cycle in some form over some period of time that's at least not in the far too distant future, as we discount that, I think one of the primary mechanisms of global asset prices discounting that will be discounting a sort of coming to a head of this philosophical crisis that constantly underlies the euro. So, and it is trending now when there's constantly calls from Goldman Sachs, JP Morgan, I've seen a few, Morgan Stanley, all recently have come out repeatedly over the last couple of months calling for the dollar to top and the euro to bottom, and it just keeps going against them. So I like that when I see that.
I hadn't thought of this before, but I wonder if the appointment of Christine Lagarde may have something to do with crisis management. Considering she was at the World Bank prior to this, she has overseen different, currency crises all over the place over the past.
She's a deal maker too. You need somebody who's more of a politician maybe than Draghi right now.
Well, and if you recall, back when Draghi was Draghi was kind of a shocker. I believe Juncker was the leading candidate, and it was almost basically a shoo-in. All of a sudden, Draghi came out of nowhere, and it was somewhat of a surprise that Draghi took over.
That was the depths of the crisis, too, so that was for the Eurozone. 2012.
All right, so now, if you think about it, there was like nobody else, no race at all. It was Christine Lagarde, and it was her job if she wanted it, and she's just etched right in place, seamless. And I just am now wondering if maybe there's this crisis management tone that the ECB wants to get out in front of, because she would obviously have lots of experience in this type of thing, seeing it at the World Bank.
I'm sure they realize that they'll be embattled. I mean, we've got Brexit's already happening, and we've seen such tension with the Italians over their budget. So I'm sure that that's part of it, and the political environment. I'm certain that she is seen as a political deal maker, and that's her experience, and that is what is probably necessary right now. And maybe they will be able to get that fiscal union going.
Yeah, well, and good connections too. I mean, being part of the World Bank, she's definitely been. She knows everybody. She's been involved with everybody. So. Yeah, I hadn't thought about that before, but I think that is maybe an underlying extra little anecdotal thing to support that short of looking out through the future for things to come. All right, Brett, bond market, anything that you're seeing?
I mean, I guess it's a little bit weaker right now than I would have assumed. I mean, the rates move was so extreme, and we're back. Well below, or we're back above that in rates if we look at it from that side. But I'm a little surprised that with recent headlines that we haven't started to see some of that resume. So maybe that's a point in favor of bond shorting and gold shorting and all sorts of stuff. But I want to see the pattern, just like with the stock market. I need to see another few days of some contours to the pattern starting to define themselves. Give me a sense of who's doing what as far as the size of the money that's really going to determine things.
All right, and then I believe it was about a week ago, not too long ago, we saw this big move in silver, and then silver kind of pulled back. We got another bid. It's pulled back again, and you used to be pretty active in the silver market, and you haven't been of late. And
I would have shorted 1895. It didn't get there.
Okay. Well, then, does that imply that you have some bearishness to this, and that it's somewhat capped, or
yeah,
is okay? All right. So
the positioning is too crazy in gold. The gold positioning I talked about with Gavin. I mean, there's the possibility of escalation of catalysts in favor, but I posted a chart the other day. The gold spec long positioning is basically right at all-time highs, higher than it was back in 2011. Like there's a massively crowded speculative long trade in gold right now. It doesn't mean it can't get more crowded, but that is something that as soon as you see the pattern play out to enable those bearish bets, you're going to get that shakeout. I'm not saying that I'm looking for a return to $15 in silver. I'm saying, I can see us spilling underneath that continuous contract 50-day and probably triggering stops around 17. And that's, pretty dramatic move. I wanted that up close to 19 if we had popped just above the bounce from, I think it was the 6th of September. There was a little tail there. I wanted to see it just run just through that tail, and it just came just underneath it and then walked sideways and then dumped. So, there was a setup there. I would have been able to understand where I put my risk, maybe around 1930 or so, just underneath that range around the highs from very early this month. So there was a setup there. It didn't give me the final triggering that I needed to see it as an active setup that I was going to participate in. But my bias is for there to be a more violent shakeout in the precious metals, generally speaking. And the fact that they're acting the way that they are, the gold is really not rebounding today, despite I would say the seriousness of things elevating in the headlines.
And my apologies. I think one of the listeners out there who said Christine Lagarde was at the IMF, not the World Bank. My apologies there. They're easy to mix up. Anyway, all right. So, Brett, are there any other markets that we need to address before we sign off for today?
No, I think we've been pretty comprehensive, and I think I would just urge people to continue to be selective because we're getting volatility building, but we're really in a moment-to-moment reaction to headlines, and it's easier to trade when you get the volatility and the headlines stop being so deterministic every few minutes. But the volatility remains, and then you get more conviction and pattern resolutions, and I would say we're heading in that direction now. We might see, for instance, a lot more interesting and easy setups next week than we will for the next day and a half.
And then you do tend to tap the brakes a little bit as we head into earnings season, which is only...
After the beginning of earnings
Right.
season, going in for the first couple of weeks of earnings season, generally speaking.
So
Maybe not this time, though, because we've got so many macro drivers. It really depends. July was a particularly acute version of that because that was such an important quarter to understand cyclically, and there weren't a lot of other headline drivers.
it is somewhat funny, though, when we've seen big moves, like, say, in September and October, historically you'll see corrections or whatever. That is kind of in the middle of earnings season when that happens.
Well, earnings season is a big input. I'm on a macro level for sure. And you're talking about year-end positioning. You're talking about whether or not people want to expose themselves to continued risk. They've got the performance they've got, and there's a lot of folks that, start to think about those year-end bonuses, and that's what they're risking. And if their bonuses are looking pretty good now, all they got to do is get out of the market to lock it in. So, and you've got banks, preparing their balance sheets. The fourth quarter balance sheet scrutiny is so much greater than all the other quarters. So they're repositioning assets and counterparty risk, and there's a lot of things that can feed in right during this period, September, and then leading to a reaction to that. And earnings, if earnings turn out to be worse than expected, that just feeds some of that likelihood. But I will say that I've done studies on this, and if you look at the beginning of the last week of October through the end of the year is by far and away the best stretch for markets of any period of a comparable number of weeks for historically. It's not even close. So the last week of October, and then including November and December, that roughly a 10-week stretch is by far and away the best performing stretch of that number of weeks of any period of the year. So whatever crash you get, it tends to lead to something good into year end. Even when we have crashes, even in 2008, that worked. We rallied during that period. So
Is it just me, or I recall that some or a lot of trading desks tend to close their books at the end of September? Am I making that up, or did I realize that in a dream? Gosh, man, for some reason, I don't know. I feel like I used to that there was something where a lot of the trading desks would close their books. Their trading fiscal year would end in September. And
you mean their bonuses are locked in then?
Yeah, I think so, maybe, but
my personal experience.
Yeah, well, you might know better than me. Sometimes, life is but a dream. Sometimes I think it just I don't know. I swear I remember hearing that.
Maybe it depends. For hedge funds, no, that's not the case. For hedge funds.
For sure, that's not what I'm talking about. I'm talking about like Goldman traders and whatnot. They close their books in September, but maybe I'm just.
Well, I don't know. We'll have to.
I thought maybe there was something. Yeah. Call your contacts, ask them if that's true, and hey, I got no problem eating crow if that's not true. It was just something that I remembered back in the prop trading days, and I don't know. Maybe it was just a rumor.
Okay.
All right. Well, anyway, Brett, I think we really got through quite a bit. That I don't think we left a stone unturned so far. It's going to be picking your spots. I think that's the best strategy that we need to apply for at least the coming weeks.
Yeah, there's going to be big opportunities. Just let them come to you.
Yeah, be careful not to get chopped up. If there's anything that you can take away, get yourself chopped up and mentally exhausted. That's the worst thing you can do.
Let me say one more.
In addition to just burning out your trading account, but having mental exhaustion and not being able to be prepared to take advantage of the moves is detrimental to any type of strategic planning when it comes to trading. So, as always, Brett, thank you for the insight.
Let me just.
You got one more?
Yeah, I got one more point. I just want to add on to what you're saying. So when you start to get higher volatility, and it could be volatility that sticks a bit, it's extremely important at the beginning of that period to not kind of get your activity off on the wrong foot. Because what can happen is you end up putting yourself in a weakened state in terms of your willingness to take advantage of more important opportunities as you start to gain more conviction if you've already taken a series of difficult losses because you've traded right into some big headlines. as the market's starting to establish that. So it can be particularly bad for your long-term outcome to begin a period of volatility. It's one of the reasons why the initial range expansion bar is so important to lay off of, and then to trade the reaction to it. It's a really good process to get yourself in the mindset of, because if you trade the initial range expansion, like, if we get suddenly out of nowhere, we get a big down day. I always see people in our feedback going, how come nobody's shorting this? What's going on? You guys are losing it, or whatever. Like, it's important to lay off of that first range expansion and then start to trade the reactions to it, so that you build up a kind of a process and a relationship with your risk as you're going to start to see better and better setups over a period of say, the next several weeks. When you start to kick off a period like that on the right note, it just has an enormous effect. When you look back on periods of volatility escalation, you've got to hit those right. And if you start off by taking a bunch of chopped up losses on the first day the market starts to expand, you start to second guess yourself. You won't take advantage of the opportunities that are there, even when they're easier setups. You won't take them with the extra size that you should when you have higher conviction. And you end up in a situation where you end up making almost nothing, making a little bit, or losing money during a period when it really needs to be that set of 2 or 3 weeks that's one of the big contributing factors of making your year. So my process is just lay off the initial range expansion a bit, and then wait for really easy, really obvious setups, and then start to build a snowball in terms of your relationship with how aggressive you can be and how you can really capitalize on that expansion and volatility. So just a lesson that I've learned over the years.
Yeah, and that's a valuable lesson that every trader really needs to always remember, because it's so easy to get sucked into that big pickup in volatility, and you feel like, oh, I should be doing something. Oh, look at the market flying all over the place.
Exactly right.
It's seductive, and
that feeling is your enemy.
Yeah, and you really need to know thyself, and when you have that feeling, you got to stay away, really, unless you are that savvy that you just know how to make money. The worst thing you can do is lose money on that day, and then you spend the rest of that range expansion and the good trades trying to make it back. And right, exactly, and being hesitant when you shouldn't be. Mm-hmm.
Yeah.
And so there you have it. There's some analysis and some education from my man Brett Manning. As always, thank you so much, Brett.
All right, thank you, Jim.
All right.